We have a number of different ways to hold property. Anybody hold real estate in your own name? Just a show of hands. Okay, a bunch of people. Anybody have it in a general partnership? No, they're kind of out of favor. Anybody have it in a limited partnership? No, they're out of favor. What about a limited liability company? LLC. A few people in the background. And anybody have a corporation? Okay, so mainly LLCs, and that's the trend, is once you own enough property that you're worried about losing it, or you have enough equity in your primary residence, you don't want to tie everything together like you are if you own it personally. So if the furnace blows up in the rental, kills the family, and you own it personally, all your assets are at risk. That's the disadvantage of owning real estate individually. With all that being said, there's special rules for California under Prop 13 and 58, which we won't get into. For California-owned property, you may want to own it individually. The current trend is towards an LLC. That's what's being used. Can anybody tell me why you're doing an LLC?
Asset protection.
Absolutely not.
What?
Absolutely
That's
not.
what they told me.
Okay, so if you have an LLC and you happen to be the manager, the person in charge, who gets to call who gets paid? The manager. So can you give away those membership interests in the LLC to your children? Yes, you can. How much money do they get each year? We don't know. They're only paid on profit. Who gets to determine what profit is? The manager. So if there's $50,000 of profit, can the manager say in November, early December, you know what, I did a really great job this year, and I deserve a what? Not a raise, a bonus. And how much of a bonus are you going to give yourself? $50,000. How much profit is left to share with your children? No. It's an easy way to do gifting because you're not giving cash flow. It's not impacting your lifestyle. But you're still transferring wealth up to $14,000 per individual. So husband and wife, that's $28,000 per child. No transfer tax because you're below the 14. So do you give them 14,000? No. Why? You're correct, but do you know why?
No, I don't. Just say I'd go 13,999.
Okay. I wouldn't recommend that.
Oh.
Because the actual rule, and that's the knowledge key, the IRS says it's $14,000 from January 1st through December 31st. Did you give a $2 Beanie Baby? Now you're over $14,000. You owe a 709 gift tax return. What's the statute of limitations on a 709 gift tax return? There is. 3 years. From when?
When you file?
When you file. So if you've made gifts for 20 years and you've never filed, how many years can they go back?
23.
23 years. By the way, what government agency is totally contrary to everything else where you're presumed to be guilty until you prove you're innocent? So is it a smart thing to file the 709 gift tax returns? Even if you don't owe money and you're below the $14,000 if you're doing regular gifting? Absolutely. There's no tax that owed, you're simply doing it. I can tell you from an audit perspective, they're looking at it, it's below 14, gone. But it's 3 years from when you file. That's the limitation. They cannot come after you. Anybody have a single member LLC that are California residents? Good. You know why it's good? No? You just know not to do it? Okay. By the way, husband and wife in any community property state, that's considered a single member. So that's why I said in California you have to be careful. So the slide says can be used to pay off creditors. The IRS has determined that if you're a single member LLC, which is what accountants like because it's a pass-through and it's just a regular Schedule E, that if you have employees and you don't pay payroll taxes, they can personally attach your individual assets. There is no distinction. There are currently 10 jurisdictions that also say there is no creditor protection on a single member LLC. So if you're in a community property state, husband and wife, you do not want to have only husband and wife, which leads you to add who? Children. Now, have you started a gifting plan right away and keep doing that because it doesn't impact your lifestyle, because it doesn't impact your cash flow? Those are the types of gifts you can give. Now, if you give your children $14,000, how much are they going to keep long term? If they're like my kids, nothing. It's all going to be gone. If you give them membership units in your LLC or stock in your corporation, how much of those assets are going to be there until you pass away? All of them. Not only that, but you pass the future appreciation of that asset onto your children, and it's not part of your estate for inheritance taxes. Everybody see that? So if you pass a 2% interest in a property in Pittsburgh, and it's 30 years from now, hopefully it's gone up a lot. Whatever you have given, that future appreciation is outside of your estate. And by the way, what's that also mean? You don't own it, creditors can't get it. But are you doing it for creditor protection? Heck no. You're doing it to avoid possible inheritance tax. Everybody understand? So most of the time, asset preservation is a secondary effect. And please remember that, because if you're on the stand, why did you do this? For creditor protection? What do you think your chances are to actually have creditor protection? Minimal. If you get on the stand and said, you know, the people that told me to do this, man, there were like 30 or 40 different things. I can't remember them all. You stand a much better chance of convincing the court and a jury that you didn't do it solely for creditor protection. That's when you get into trouble.